Welcome to the Explainer. So what if you could put a number on the absolute worst-case scenario for your investments, no matter how wild and unpredictable the market gets? Well, today, we're going to crack open a 19th century mathematical secret that does exactly that. Financial models, they just love neat, predictable patterns, right? Like the classic bell curve. But we all know the real world, with its market shocks and crazy new assets, doesn't always play by those rules. Those patterns break. So, how do you manage risk when you can't even trust your assumptions? Okay, let's dive in. The thing is, those traditional models, they can fail. And I mean spectacularly during what we call black swan events. The kind of totally unpredictable disasters that can just wipe out entire portfolios. So that's where we need something different. We need a tool that sets a hard floor for risk, a worst-case scenario that's guaranteed, no matter what. And this right here, this quote, it kind of hints at the solution. It's talking about a rule that provides a guaranteed minimum, a probabilistic safety net, if you will. Okay, so this is where a 19th century Russian mathematician, a guy named Tchebyshev, comes into the picture. Now, he wasn't trying to predict the stock market or anything, but he developed this incredible theorem that gives us an unbelievably powerful safety net. And the best part? It works for any set of data, as long as we know just two simple things about it.
All right, I know what you're thinking, a formula. But don't let it scare you off, because its power is really in its simplicity. All this is saying is that we can find the guaranteed minimum chance that any outcome is going to land somewhere close to the average. And all we need to know is the mean, the standard deviation, which just measures how spread out the data is, and this little number k, which is just how many standard deviations we want to look at.
And these three things, this is really the magic of it all. This is what makes it so dang useful, especially in finance. It's distribution-free, meaning you don't need to know if your data looks like a perfect bell curve or something totally bizarre. It works for tech stocks, emerging market bonds, crypto, you name it. It's a truly universal safety net. And you might be wondering, okay, but is this just some rule of thumb? Nope, not at all. It's built on a rock-solid mathematical proof. The really brilliant part is step one, where you square the distance from the average. This clever little trick makes all the values positive, which then lets you apply an even simpler rule to get to this universal guarantee. It's just elegant. Okay, enough theory, right? Theory is great, but let's see how this thing actually works in practice. We'll start with a classic example, a venture capitalist making a really risky bet on a new startup. So let's imagine you're a VC. You're looking at this single startup, and the potential outcomes are all over the place. There's a small chance of a huge win, a pretty decent chance you lose everything, and a few outcomes in between. This is exactly the kind of messy, unpredictable data where a tool like this becomes your best friend. So, first things first, we gotta figure out the average expected return. You run the numbers, weighting each outcome by its probability, and you get an expected return of $5,000. All right, next up, the standard deviation. Now, remember, this just tells us how spread out or volatile those returns are. And in this case, whoa, it's a big number, about $11,000. That's a huge clue that this is a very risky bet. Okay, now we get to the fun part. We're going to ask the big question. Let's set our k value from the formula to 2. We want to know, what's the guaranteed absolute minimum probability that our final return will land somewhere within 2 standard deviations of that $5,000 average? So we just plug that number, k equals 2, into our handy little formula, and bam, we get our answer, 75%. Tchebyshev's theorem gives us a rock-solid guarantee. There is at least a 75% chance that the final return will fall somewhere between a loss of about 17 grand and a gain of 27 grand. Just like that, our VC has a concrete, quantifiable floor for their risk assessment. So, that's a nice little hypothetical. But what about the real world? How does this hold up on, say, Wall Street? Let's take a look at 5 years of actual daily returns for Apple stock and see what we find. Okay, just look at these numbers. It's fascinating. No matter how many standard deviations we look at, 1.5, 2, 3, the actual percentage of days Apple stock stayed in that range is way, way higher than the Tchebyshev promised us. And why is that? It's because while Apple's returns aren't perfectly predictable, they also aren't completely chaotic. They tend to cluster around the average more than Tchebyshev's absolute worst-case scenario assumes. This chart really puts it all into perspective.
When we looked at two standard deviations, Chebyshev's theorem promised us at least 75% of Apple's daily returns would be in our target range. The reality, a whopping 95.6% of them were. The safety net held, and it had plenty of room to spare. Now, you might be thinking, well, 75% isn't that close to 95%. Isn't the theorem kind of bad? But here's the thing. That conservatism is actually its greatest strength. It's a feature, not a bug. And we can see why when we compare it to the more familiar empirical rule for bell curves. This right here, this is the whole ballgame. Think of it like this. The empirical rule is like a super specialized Phillips head screwdriver. It works perfectly, but only on Phillips head screws, or in this case, normal distributions. Chebyshev's rule? It's your adjustable wrench. It might not be as perfect a fit, but it'll work on almost any nut and bolt you throw at it. It's indispensable when you're facing the unknown. Okay, so let's bring this all home. If you're a portfolio manager, a risk analyst, or even just a curious investor, what's the big takeaway here? Why should you really care about this?
Look, it all comes down to building a truly robust risk model. You're not just crossing your fingers and hoping for the best. You are mathematically preparing for the absolute worst-case scenario. And Chebyshev's theorem is the tool that lets you do that with real confidence. But of course, there's always a trade-off, isn't there? This incredibly powerful universal guarantee comes at the cost of precision. Just like we saw with Apple, the reality was often far better than the worst-case scenario. And this leaves us with a critical question for any risk manager. When is a guaranteed safety net absolutely essential, and when does its conservatism become a limitation? Something to think about. Thanks so much for diving into this with me today.